to go for the this session, and it's kindly delivered by the people at Menzies, both Andrew Norman, who's the VAT Director, and also Sarah Barron, who's VAT Senior Manager. And the topic will be getting the most out of available reliefs and VAT recovery. So it leads on really nicely from the previous presentation we had. Andrew's VAT Director based in the London office and has been advising on VAT for nearly 25 years. Previously with HMRC before moving on to practice, and has been involved in charity and not-for-profit sector for more than 20 years, giving VAT advice for a range of clients from large national charities to smaller local ones as well. So really covering the whole gamut of the sector. So without further ado, I'll pass on to Andrew. Andrew, take it away.
Okay, it's actually Sarah that's starting. Sorry, Richard.
Apologies. Sarah, take it away.
So yes, as mentioned, I'm Sarah Barron. I'm a senior manager. I'm based in our Solent office, so down on the south coast, and I work in our VAT advisory team. I have a background in accounting and general tax as well, so I've come through the whole gamut of the profession. So our brief today is to talk to you about getting the most out of available VAT reliefs and recovery. As I saw Alison's presentation previously, when you are unable to recover VAT, it's really important to make sure that you don't pay too much of it. You know, making sure you're paying VAT at the correct rate and using the reliefs available is even more vital if you're in the charity sector. So, see if we can go on to the next slide. No. Sorry, my tools have disappeared. There we are, right. So, the reliefs available, we're going to look at some of the zero rates and the reduced rates, and then I shall hand over to Andrew, who's going to look at VAT recovery rules and things to consider to optimise recovery. So there was a question in the earlier sector in the session about can we distinguish between zero rated supplies and exempt supplies? And from the purchase side, it's important that you can recognise that distinction, because your supplier, if they're making the zero rated supply, and we refer that to those as the sweet spot, they are the win-win for everybody. Your supplier is making a zero rated supply, so it's taxable. They can recover the VAT that they incur on their costs. So the amount that they charge on to you is net of the VAT that they've been able to recover. If your supplier is making an exempt supply to you, they're not able to recover the VAT on their costs. So when they calculate how much their bill to you is going to be, they're going to have to include the VAT that they're not able to recover. So you know, we have reliefs for zero rated items. We've also got reduced rate and exempt items. And VAT legislation is really prescriptive on what can fall into those categories for relief. So basically the VAT Act says that if you make a supply to somebody of goods or services, you assume that those things are going to be subject to standard rate of VAT, unless they fall into any of the categories of relief. So yeah, we need to make sure if you do have a zero rating available, you're using it and you're asking your suppliers to give you that relief. So the VAT Act sets out in Schedule 8 the things that apply that get zero rating applied to them. Exemptions set out in Schedule 9. And then we've also got a separate schedule with the reduced rating in. So those are the general items that fall into zero rating. And looking at charities specifically, if we look at just a few of the things that get relief, there's the sharp ones among you will spot a typo in that slide. It's actually group 15. So it's you know, the items, these are things that specifically charities are able to purchase at zero rate. So one of the ones that causes some really thorny issues is the advertising. So this was specifically brought in, very historic changes that were brought in to allow zero rating advertising for charities. And it's only when they're making available to the public an advert, and it was brought into when zero rating was removed on advertising in newspapers, and it was just a concession given to the charity sector. So it's got to be something that's made available to the public at large. So it's got to be in a public place. That doesn't apply to adverts that are placed on your own website, and it doesn't apply to anything that's directly targeted at a specific group or person. So direct mailing wouldn't qualify. And the real knotty one, where the legislation and the technology just don't work together. The legislation on how the zero rating works was written well before the internet was invented. So click-through advertising is causing lots of knotty problems and several cases and challenges going through to try and get the scope of the advertising relief extended to those. We also get zero rating when goods are donated to a charity for sale. Again, if a business donates goods and it gives them away, because that's a non-business activity, it wouldn't be able to recover the VAT on their costs of those goods. So if they're able to give them to you at zero rate, they can hopefully give you 20% more goods for you to sell. So that's any goods that you're going to sell, so you know, in a charity shop or sell on from your website, would be available, have zero rating available for the person that's giving those to you. And then again, there's the relief for relevant goods. So these are items that are purchased from charity funds. So there's the relief in group 15, and there's also the relief in group 12 for items that are given to individuals for use for their personal and domestic use as well. So charity funded items would be technical equipment for research, medical veterinary research, goods for personal use, and that includes adapted cars and vehicles as well. So the really big relief, which is really helpful for charities, is if you are able to acquire a building without VAT. Obviously, you know, buildings cost a lot of money. If you're having to pay an extra 20% on top of that, it can be make or break on the project. So purchasing buildings, and this applies to new dwellings and buildings for relevant purposes, so relevant residential purposes like a care home or relevant charitable purpose. The first sale of those by the person who's built them can be zero rated, as can construction. So if the charity decides to buy in the construction services themselves, manage the project building themselves, they can receive building services without paying VAT. And again, because the supplier is able to zero rate their supply to you, they can claim on the materials that they buy to build that building for you. So to get that relief, you have to give a certificate, and to give that certificate, you are declaring that you qualify for that relief. So this is an area where real caution needs to be applied. If you give that certificate incorrectly, normally it's the supplier who is liable for making sure that the correct rate of VAT is charged, and it would be the supplier that was on the receiving end of any assessments, penalties from revenue if they got that wrong. For the purposes of getting a zero rated building, you have to supply a certificate to that supplier, and if you do that carelessly, incorrectly, without taking due caution, you can become liable then for a penalty equivalent to the amount of VAT that should have been charged. So that's one to take really, really carefully and make sure that you are absolutely certain before you sign that certificate. So just a brief touch on the reduced ratings available. I think Alison mentioned that the normal rate of reduced VAT is 5%, and that generally applies to you know, fuel and power and some work on existing buildings. But we have a special rate in play at the moment. So in respect of the fuel and power, supplies which are for qualifying use, so that's for use, domestic use, and also for use by a charity, and that can be used in a mixed use building. So long as 60% of the power is being used, or the use of the property is for non-business purposes by the charity, they can provide a declaration to the power supplier and get that power at reduced rate. And that even if they're over the 60%, as long as it's only a small supply, so you know, anything where the supply is less than 1,000 kilowatt hours per month, that would still fall into the qualifying use and still get the reduced rating. So on the special rate for the COVID relief, that comes to an end. So this was a special temporary reduced rate for supplies of catering, holiday accommodation, just to help out the staycation businesses throughout the pandemic. And that's being phased out now. So it's currently, it stands at 12.5% on those things. But if you're, and that finishes on 31st of March this year, but if you're able to fix a tax point now, you can take advantage of that 12.5%, even if the trip doesn't happen until the summer. So if you're planning residential trips, any accommodation that's not going to be used until after the 31st of March, if you can persuade your supplier to issue an invoice early, or if you can make some sort of payment to them before that 31st of March date comes about, then you can fix that 12.5%, at least on some of the costs, so that you are not paying the full 20%, which will come back in after that date. So I'm going to end my slides now so that Andrew can take over and he can do his section on VAT recovery. You're on mute.
Good morning, everyone, and thank you very much for that. I'll start again since I muted myself. Hopefully, I'll effortlessly take over the display of the slides. There we go, all up and running. Yes, as you know, I think that the point of that session was to just give you a flavour of some of the reliefs available to charities, so that you can minimise the cost of VAT or VAT on your costs. It's also quite important to realise that those reliefs are available, because HMRC can be quite nasty at times, and if you're charged the wrong rate of VAT, they won't always allow you to recover it, even if you're entitled to recover any VAT that would have been charged. So it is important, and also it has a sort of cash flow impact. You know, if you're paying the wrong amount of VAT and waiting for recovery, it takes a bit of time. In these couple of quick sessions here, I'm going to try and go through the sort of basic principles of how we deal with VAT recovery once we've incurred that VAT on our costs. So the basic principles are, if we incur a cost for the purpose of making a taxable supply, then we are entitled to recover that VAT. It doesn't matter whether you're a business or a charity. Now, what do we mean by taxable supplies? I think Alison probably touched on it a little bit in one of her explanations. They are supplies that we make whereby it's liable to VAT. So it's a standard rated supply at 20%, one of the reduced rate supplies, or even a zero rated supply. If we're making those supplies, so as a charity, let's say, you know, if you've got your shop within the charity and you're selling your donated goods, those are taxable supplies, and those are zero rated taxable supplies. But any costs that relate to that, we can look at recovering. We also have a couple of other activities or other types of supplies that we need to consider. We have what's known as exempt supplies, and these are supplies that are specifically exempted under the relevant legislation in the VAT Act. For charities, most of that is around welfare and medical supplies, as well as there's lots around land and property, which we might be involved in. In addition to those, charities are normally involved in what I would say are non-business activities. So typically what we might have here is you have a helpline, a free helpline, there's no charge for it, but there's an activity going on, you're probably incurring costs against it, so you wouldn't be entitled to recover the costs on non-business activities or even exempt supplies. So once we've got our costs, what should we do with it? We need to attribute that, and the way that we should be looking to attribute this is we ought to identify that cost and say, where do we use it? Do we use it solely in making taxable supplies? And if it's solely in making taxable supplies, then yes, we can recover all that VAT. It could be a cost that is used solely in a non-business activity. So in my example of the telephone helpline, the cost of providing those the telephone equipment, the line rentals, if you know, free calls coming into you, etc. So that would be a non-business activity, and if that was a separately identifiable cost or separately billed, you wouldn't be able to recover that because it relates to a non-business activity. Similarly with exempt supplies, subject to certain de minimis limits, which I'll talk about later. If you make exempt supplies and you identify a cost that relates solely and only to that exempt supply, you're not entitled to recover the VAT on that cost. However, life isn't always that simple, is it? Generally, there are a lot of costs that probably go over more than one activity. So if it's one of those types of costs, that is when we come to look at how we should, you know, how we should divide that up, and the sort of areas that we can look at. So I think there's 4 possible combinations. There may be others, but if you have a cost that relates to both your taxable and exempt activities, and only your taxable and exempt activities, then what you have to do under VAT law is you have to attribute that cost between those taxable and exempt activities, and that's what's known as partial exemption. You might also have a cost that relates to taxable and non-business use, in which case you have to somehow split that between the taxable use and the non-business use. The VAT that you allocate to the taxable use, you're entitled to recover. You could have exempt and non-business use, no recovery here. So why do we bother splitting this? Well, this probably only happens for charities which have perhaps very little exempt use or very little exempt activities. Because of those de minimis limits, you'd have to split that section out, and then you might be able to get some recovery under those de minimis limits, and I'll talk about those limits in a couple of slides. And finally, obviously, there's the one that is the true overhead of everything you do. It's going to relate to taxable, exempt, and non-business use. And so in those, you'd probably have to do you'd have to break it down twice. You'd have to strip out the non-business use and then put it through a partial exemption method. if we look at how apportionment methods are set out and what we need to do, for business, non-business, there are no specific rules. There's nothing in the legislation that says you have to use a particular method. All you have to make sure is it is fair and reasonable. In fact, you don't have to agree that method with HMRC, although it is probably advisable for larger charities and charities that have a lot of non-business activities. So how do we do that? We'll come on and look at the sort of ways that we could do this, but it basically anything goes. As it always reminds me of, sorry, I was watching this over Christmas. It was the the Indiana Jones, and I think it's the Temple of Doom, and they sing the song "Anything Goes," and it always sort of springs into my mind at this point. We've also got partial exemption methods. So just to recap, partial exemption methods are the method that where you attributed a cost to both taxable and exempt. This is how you split it. Now, the law does set out a method that you must use unless you agree something else. So this is known as a standard method, and this is based on income. Very, very simply, you take the value of your taxable income in the period and you divide it by the value of your taxable and exempt income. We're not talking about non-business. Non-business doesn't kick in here. And that gives you a percentage which you're entitled to round up, and then you apply that percentage to the VAT that you've allocated as an overhead for your partial exemption calculation, and that, so the percentage times the amount gives you the amount of VAT you're entitled to recover. We also, under the legislation, are able to agree what's known as a special method. And a special method is anything that isn't a standard method. So it's got to be fair and reasonable. It's got to be agreed in writing with HMRC, and that's about it. That when you put this in, there's quite a lot of work that needs to go into it. You have to demonstrate why it's fair and more reasonable than the standard method. You need to set out examples of how it works and give it projected figures, etc., etc. For both methods, the initial recovery is only sort of provincial in the year, and then you do an annual adjustment at the end of the VAT tax year, which will be set by your VAT returns, but it's the VAT tax year normally ends either 31st of March, 30th of April, or 31st of May. I've mentioned before when we were talking about partial exemption and de minimis limits. So what the de minimis limits are, and they have been set at this level, I think, for as long as I can remember, maybe even a bit longer than that, so probably at least 20-25 years. What it says is, if the amount of VAT that you've allocated to your exempt activities, so that's both by the direct attribution and by your method, your partial exemption method, if the sum of those two is less than £625 on average per month, which is £7,500 per year. So 20 years ago, that was quite a lot. Today, it's not so much. And that is less than 50% of your total VAT that you're claiming, you can have it all back. And it could be that in a couple of quarters, you're over those limits, so you don't recover it. End of the couple of quarters, you're under. At the year end, you're still under, so you can go back and pick up the VAT where you were over. Unfortunately, with all these partial exemption methods, they've been sort of got more and more complicated, and the rules around them have become more stringent. There are also overrides which can be applied both to the standard method and any special method. There are different rules about when these apply and who can apply them, but basically the override, if you like, gives customs and the business and the charity, when they're on the standard method, the right to say, no, this method is wrong, we can use another method, even if we haven't got it in, we can put, HMRC will push you onto a special method or push you off the special method. Where you can argue that 2 years ago we didn't agree a special method in time because special methods can't be backdated, but we can apply the special method override, the standard method override, and we can effectively backdate the special method. There are limits on that, and I think there's a £50,000 difference limit, so it's a really only impact on very large charities with quite a lot of input tax that they're looking at under partial exemption. As I said, you've got to do a business non-business as well as a partial exemption. You can combine those methods, and that is allowed. I would again say you probably need to agree these with HMRC in advance. The trouble with that is the de minimis limits don't apply because it's not technically a partial exemption method. So there's a little bit of a downside to combined methods, but some charities might find it a little bit easier to use that. So that was a very quick whistle-stop tour of how methods work. I hope that's answered a few of the questions that people had. It's my view on partial exemption is it's not actually difficult. It's the allocation that is the key point. So we need to make sure we're allocating costs correctly. So how can we optimize that recovery? What can we do? What sort of steps should we take? Alison was talking about this a little bit earlier on and was giving me a bit of a heart attack because I thought she was going to steal some of my thunder. So how do we attribute those costs? So can it be simple, or does it have to be complex? I guess that really depends on what you want. Simple methods are always easier to follow, but they may not be perhaps as accurate or give you as much recovery. But there's a benefit that you've got to decide whether that's cost effective for you. So the first step is business non-business attribution, and I guess what we've got to we've got to be fair, reasonable, we've got to be honest. But if there is a business use to a particular cost, even if there's it's very high non-business, that should go into the attribution between business and non-business. Similarly, once we've done that and we're looking at the VAT that we've allocated to business, is that just business taxable? Have we made sure that we've maximized the values going into that? Where we're allocating costs to just exempt use, are we certain that there isn't any taxable use of those costs? So we're minimizing everything that we put into the exempt bucket, if you like. And then we look at the overhead attribution. Does this give us a fair and reasonable result? Should we, does the standard method, if we haven't agreed a method, does that give us fair and reasonable? Could we get perhaps a better result using a special method? And then again, once we've gone through those steps, once we've done the attribution to exempt and we've done the overhead attribution, do we fall within these magical de minimis limits for the amounts we've allocated to exempt? Because there's money that we're entitled to there. So what should we look at in apportionment methods? Simple or more complex? Well, you've got to be able to use the method, you've got to be able to explain it to HMRC, and HMRC have got to be able to check it, which is why HMRC like income, because it is very, very easy for them. You've got income in your accounts, you produce accounts, they can see this, they can track income down. It's something that just about every charity or business would have, statements of income. But that's not the end of the matter. You don't have to do that. Are there records that you produce normally within your business activities that could help support a different method? So things like that. Should we have a combined business non-business, or do we need separate ones? That again will depend on your circumstances. But you need to look at it and think, what's the benefits of splitting out the non-business first, and then doing partial exemption. When we come to doing, if we have to do partial exemption, is it a special method or standard method that we should use? And then at the end of this, let's be realistic. We need, you know, time and effort reward. So if we spend hours doing this and we're only getting an extra few £100, is that actually the best use of the resources of the charity tax, the charity finance teams? Could they be better employed doing something else? So again, that's a personal call for the charity to make. Obviously, charity governors, etc., would perhaps need to make sure that they've examined that and have got a good, you know, say, no, it's not cost effective for us to do anything more complex. There isn't the money there, but, you know, they need to be able to say that with some degree of assurance, and that's what they'll be looking to you as finance teams. So just a quick canter through sort of some of the things we can do on special methods, because I'm probably heading towards the end of my time on this. So we start at the top, sector methods. So if you know, as a charity, if you've got different sectors, you might impose different recovery methods on those different sectors. So I'm just trying to think of a good example here. You know, a charity that perhaps runs a tourist attraction, let's say, you might have a cafe section, you might have a gift shop. Those could be separate sectors within your method so that they give you recovery. You would have to have, if you do a sector method, especially that would come under a special method, you would need to make sure that you've got something that covers any unidentified sectors that you might suddenly develop. An alternative one is floor space. You know, if you've got a building and you've got one floor used for non-business activity, then that might be how you apportion your non-business costs, if you like. Similarly with headcount, you know, if you've got staff involved in only certain actions, certain sides of the business, whether that's business or non-business, you can use those as a way of identifying or doing your apportionment. Transaction count. This I've seen more in sort of financial services sectors, but it can apply to charities, especially if you've got donations and people sort of ringing up. You know, you could use that as a transaction count, or number of calls that are made. You know, so I know a charity, or well, a not-for-profit body anyway, that gives free advice, but then if it gets more complicated, they start having to charge for it, and that could be how that works. Interestingly, costs is there. Before the current standard method which was based on income, the standard method was actually based on an attribution of costs. So that could be as simple as anything that you get full recovery on divided by anything that you don't get full recovery on, and or the total costs, etc. There are also, you know, you've got to consider these. You'd have to argue your case with HMRC on these. And HMRC can have some funny ideas about what's fair and reasonable. I'm sure Alison's probably smiling at this point, as she knows that too well. There are also, you know, you don't have to stick to just one of these methods. You can combine them. So it's like the sector method. One sector could be floor space, the other sector could be headcount. So there's a lot of things to consider there. For most charities, I think they'd probably be on income-based methods. I do have reservations on income-based methods, especially for business, non-business, because if you're receiving donations, one donor gives you £10, another donor gives you £10,000, you probably incurred the same costs to receive that donation. That's a non-business activity, receiving the donation, if you like. It doesn't entitle you to VAT recovery. But if you put that into an income method, it could make a big difference as to the sort of VAT recovery that you get on your overheads. And you probably use the same space, excuse me for a minute, to, you know, the same sort of time, cost and space to process both donations, but they might have a very different impact on your recovery methods. So just to finish off with, thinking about what other considerations could have an impact on your VAT recovery methods. I think we had some questions on this about trading companies, and Alison touched on VAT grouping. But yeah, this is, is it best to have your trading company in the same VAT group? Now, a VAT group is where you combine the charity and the trading company to under one VAT registration, and they're treated as a single VAT entity, and that gives you the sort of recovery rights over the overheads. So it could be useful to VAT group. Alison mentioned lotteries being outside of VAT groups because they probably have a lot of exempt income, which would reduce your VAT right to VAT recovery. What has the sort of changes in your businesses, your charities over the last 2 years because of COVID? How has that impacted your recovery? Has it improved? Has it, had a real adverse impact on that? And I think there are some special rules around partial exemption methods that HMRC tried to brought in to try and help. But it is useful. I mean, and going forward, we're in a slightly different position, society, etc., way of working going forward, and perhaps will be for a while. How is that going to impact on our recovery methods from 3-4 years ago? Are they actually fit for purpose still? So it might be, worth revising those, looking at those, seeing whether there's any benefits that can be made. What about recharges and bad debts? I think Alison touched on these again. Are we dealing with these correctly? Do they feed into our methods? So yes, if you are making a recharge from the charity to a trading subsidiary, or even another charity, like within, you've got a couple of charities within your sort of scope remit. I know that in the education sector. Then those recharges might attract VAT and create some VAT problems. It might improve your recovery rate in the charity that's making those recharges, but you could, sort of the downside is the VAT that might not be recoverable in other areas. So I hope that's sort of given you some idea of where, the sort of things that VAT recovery you can do. There's nothing set in stone apart from the partial exemption standard method, unless you want to change it. But there are obviously, to be able to maximize recovery within a charity, you really need to understand what the charity does, did various activities, how they're treated for VAT, and then where your costs are incurred against what activity are those costs put, to be able to make sure your recovery is maximized, fair and reasonable, whatever word you want to choose. Okay, I think I'm probably just about on time, maybe a little bit over. Apologize for that. Richard, over to you. Have we got? I saw one question came up.
Yeah, we've got a couple of questions I think we can answer. We can shorten the break slightly, I think, because it is a really important topic. I'm sure there'll be questions here. There is one we've got from Dave Taylor, and it's if we have a new build where the building is part exhibition space, part cafe, social centre, and part shop selling donated goods, can we claim zero rate on the construction, all of it, or is it partial or none of it?
Andrew, are you happy to take that? Because I'm afraid I'm going to have to leave you because I've got another call coming up.
All right, no problem. Yeah, thanks. Sure. So what the legislation says is that if you use a building for non-business activities of a charity, and if that is, I think I'm right in saying it's up to 95% or more, then the construction of that building can be zero rated for VAT purposes. Now, how you determine what is business and non-business use within that building is not set in stone, and you can do various methods to look at that. Talking, if you going back to this one, you said you have an exhibition hall and a cafe area, etc. If it's an exhibition hall and you're hiring it out or renting it out, and then that will be a business use. You probably look at opting to tax the building, perhaps to recover VAT on that initial build cost. The downside of that is you'd have to charge VAT on those rents if you're hiring it out to other users. The cafe area, again, if you're selling drinks, coffees, food, etc., that's business activity. So maybe on a floor space, you straight away hit over that 5% margin. I think I'm right in saying it's an all or none, although there might be some scope if you have separate areas, discrete areas, you can get that discrete area zero rated. So I think I did some work with a religious charity where they built sort of community buildings where there was a worship hall, there was a cafe, etc., and where we were able to carve out areas which had only non-business use, we were able to zero rate that part. So it does depend on exactly how you're going to use that building, perhaps the layout of the building, etc. But yeah, I think, yes, if it's an exhibition hall and you're hiring it out, I don't think you get very much chance of a zero rating on the construction, but you might want to consider, as I say, how you're using it and whether it would be beneficial to look at VAT recovery. But to be able to do have VAT recovery, you'd have to make the sales, if you like, the use of the building taxable, which is where this option to tax come in. That's about another 2-hour topic that we could discuss. But I hope that sort of answers the question. If it doesn't, please let me know, and I'm more than happy to take it offline and have a quick chat.
Fantastic. I think we've got one more here from Nicholas. We have got a question previously from Denise, but I think that can be covered in the next section on specifically on trading subsidiaries. So this from Nicholas is, if you have a trading subsidiary and put it into the VAT group with its parent, would you just do one BNB and PE calculation on the combined figures?
You would do one partial exemption calculation, yes, because you're treated as a separate entity. The business, non-business, not necessarily. You could still split, you could have a separate recovery rate, if you like, on costs incurred for non-business activities in the trading subsidiary compared to the charity. It just depends on what you've got agreed or what what you've had with customs historically. But yes, when you combine those activities for business purposes, i.e. the business activities, then you just do one partial exemption method. So in that instance, you might have some negative impact if the trading subsidiary had its own premises, for instance, makes predominantly taxable, but the charity has some exempt. When you combine them together, then it might be that the overheads of the trading subsidiary's premises you only get partial recovery. Depending on, as that goes back to optimizing your allocations on your costs. So yeah, there's lots of things at play there, but yeah, generally speaking, yes, you'd have one single method for partial exemption, probably business, non-business as well, because it's simpler, but not necessarily.
Yeah, that's really a helpful answer. I think we've got a few more questions, but I think if you do want to address those to Andrew directly, his details are obviously on the screen, and same for Sarah. And we do have a session coming up in 10 minutes time, which will look at some of these issues too. But the only thing left to do before we break is thank Andrew and Sarah for the presentation. Really helpful and went into a bit more detail on some of the topics we've heard about previously as well. So a really good presentation there. Thanks very much, Andrew.
Thank you, everyone. Thank you for your time.
Thank you. So we've got a 10-minute break now. So we'll come back at 11:15, where we'll hear more from the team at Menzies. But this time a little bit more about trading subsidiaries. So we'll look forward to speaking at 15:15. So see you all then. So thank you. We're recording now, which is good. And as mentioned, we're joined by Lucy Mangan, who's partner tax team at Menzies. So continuing on with Menzies, looking at taxable income from a trading subsidiary perspective. I've heard from Lucy that we're not going to touch on as it relates to VAT so much, but more around corporation tax and other issues. But Andrew will be sticking around to answer any questions we had from the previous session towards the end. So just say that Lucy's a partner in the tax team in the Heathrow office, a chartered accountant and chartered tax advisor. She joined in 2014 and became a partner in 2018 as well. So we'll hand over to Lucy. Lucy, take it away.
Great, thanks very much, Richard. I hope everybody can hear me okay. If not, please give me a shout. Thank you. So yes, as Richard said, today I'm going to talk to you about charities and the use of a subsidiary in respect of trading activities. So I'm going to talk about why a charity may wish to consider a trading subsidiary, and I'm going to talk about the taxation of trading income within a charity to give some context to why it may be worth considering using a subsidiary and the potential tax benefits that could arise. And finally, I'm just going to flag up some things that you need to think about when considering this issue. So why may a charity consider using a trading subsidiary? Well, there's quite a lot of reasons. And the first reason is really, and it's a very important one, to protect against risk. By ring-fencing trading activities within a subsidiary, you can protect a charity as much as possible from the commercial risks of that trading activity. So the assets of the charity should be protected, and also if losses arise from those trading activities, then they do not arise in the charity, they arise in the subsidiary. If trading losses were to arise in a charity, then it can bring with it some consequences. If those losses arise from activities which are non-primary purpose, and there is a risk that they can't be supported as being carried on a commercial basis, then the charity can end up with taxable profits. Of course, the charity may also be liable for the debts of the loss-making trade, and the trustees could also put themselves at risk for breaching their duties if the loss arises in a trading activity within the charity. The trade itself may not advance the charitable purposes, and therefore the governing documents are very important to understand. They may not allow a charity to carry out such trades and that don't advance the charitable purposes themselves. Whilst the tax rules allow charities to carry out such activities, the governing document is the main document, and that trumps anything else. So it's very important to understand what the charities governing documents do allow it to do. If the trade that is to be carried out is sufficiently large, then it could also risk the charitable status itself if that isn't being carried out for charitable purposes. It can be very useful to have clear distinction and clarity between the activities that a charity is undertaking and what a subsidiary is undertaking. It provides a clear distinction both internally and externally, and can be useful for things such as messaging, PR, and also for financial reasons. And then finally, the tax efficiencies, which is my focus today, and we'll move on to discuss in more detail. But there are many, many reasons, both tax and non-tax, where a subsidiary can be useful for a charity. So moving on to discuss the tax status of trading income within a charity, so that we can provide a context for why a subsidiary may be useful. So what is the status of trading income in a charity? Well, it's a bit of a misconception that charities are exempt from tax. They're not exempt from tax. They are subject to the tax rules as for any other corporate entity. However, there are a number of exemptions within the legislation which can effectively exempt the profits from tax. But it isn't a blanket, charities are exempt from tax. I think as Andrew mentioned earlier, it's equally as important for direct taxes, for corporation tax, that a charity understands what its activities are and whether they may amount to a trade or not. There are various exemptions, and to be able to understand the exemptions that apply, you need to understand what the activities are. I'm not today going to run through what amounts to the nature of a trade or the badges of a trade in any detail. The rules apply for a charity as they do for any other corporate. And in most cases, it will be obvious that a trade is being carried out. Generally speaking, a trade is the provision of services or goods in return for payment, but it is not always that clear cut. And whilst I'm not going to discuss this in any real detail, there are a couple of areas that I just wanted to flag up, because I've seen these come up in practice a couple of times, and well, a number of times, and it's quite easy to fall foul of them if you're not reviewing what your activities actually are. So Often charities will rent out land and buildings, and that's the first aspect I would like to talk about. Rental income is exempt from tax under the rental income exemption. However, if the charity is providing anything else, any services in addition to the rent, then depending on what those services are, that can mean that that activity is actually a trading activity and not rental income. And therefore it's the trading activity exemptions that you would need to consider, which we'll move on to, rather than the rental exemption. And it's quite easy, as I say, for the nature of the rental arrangements to change over time and to accidentally fall within the trading definition. The other area that comes up quite frequently is sponsorship. So you may be running an event or a project where you obtain a receipt of income from a sponsor. Now, generally speaking, you'd think that would be fine, and a small acknowledgement or recognition of the sponsor at the event, that will be absolutely fine. But if the sponsor obtains significant advertising, or the charity provides any other service, for example, the use of its logo or a link to the sponsor's website or endorsement of products or other aspects, then that sponsorship can actually amount to a trading activity, and therefore again it is the trading exemptions that you need to consider. So it's very, very important that the charity understands what activities it's carrying on or is about to carry on, so that the relevant exemptions can be considered and applied. So once it's been established that the activities are a trading activity, what are the exemptions for charities from tax against these activities? Well, there's two main exemptions, the primary purpose and the auxiliary purpose trading. And if the trade falls within those exemptions, any profits arising would be exempt from tax in the charity, as long as the profits are used for the charitable exemptions. If the trading activities do not fall within those exemptions, then they still may be exempt from tax if the income falls within the small trading exemption. If it doesn't fall within any of the above three, then it's non-primary purpose trading, and any profits are subject to tax in the charity as they would be for any other company. So moving on just to consider these exemptions in a little bit more detail. Primary purpose trading, this is usually fairly obvious, and it's trade that forms the integral part of meeting the objectives of the charity. So, for example, schools charging fees, art gallery admissions, provision of healthcare services, and there's various other examples. These are clearly meeting the objects of the charity and would be primary purpose trading. And therefore, if they're carried on within the charity, which would normally be the case, then they would be fully exempt from corporation tax. You may still wish to consider the use of a subsidiary for non-tax reasons, such as the risk that we talked about earlier, but from a tax perspective, it should normally be fairly clear that these sort of activities fall clearly within the primary purpose and would be exempt from tax in the charity. If the trade is carried on by the beneficiaries of the charity, then it's also exempt from tax. This is less needed or less common to be relied upon, because those activities will also often fall within the primary purpose, but it can be very useful, in particular some of the examples set out on the slide. So if students operate a farm or a restaurant, all goods manufactured by the beneficiaries are sold, it can be useful, and this exemption can apply. Again, if it falls within this exemption, there's no limit, and all of the profits would be exempt from tax in the hands of the charity. A couple of questions which often come up on this area. Firstly, is it possible to pay the beneficiaries for the work they do? Absolutely, that doesn't impact the exemption from tax. But also, often it's not possible for the beneficiaries to purely carry out these activities on their own. They need a non-beneficiary, such as a manager, to help these operations work. That is also absolutely fine, as long as the non-beneficiaries that are involved are a small proportion. The greater proportion of the trade must be carried out by the beneficiaries for this exemption to apply. And that is an area where you need to take care, and where it may be useful to look at a subsidiary. So ancillary purpose trading, this is trading that is so closely linked to the primary purpose. It's really a byproduct of the primary purpose. It's not directly linking or achieving the charity's objectives, but it's very, very strongly indirectly helping. So again, some examples are set out, fairly obvious: books to students, the provision of food or drink in a cafe or a restaurant, but please note, to visitors of the art gallery, heritage site, or a theatre, for example. So often there's a cafe or a bar or a restaurant, that's absolutely fine if it's available to visitors, so the beneficiaries of that charity. You do need to take care if the food or drink or the restaurant or the cafe is open to the general public. Any sales to the general public would not fall within this exemption and would be subject to tax. And again, another question that comes up quite frequently is what aspects that are being sold in a shop, what would meet the ancillary purpose trading and what would not. So taking an art gallery, for example, any books on the arts, that would be absolutely fine. Cups, tea towels, pencils wouldn't be. And you can end up in a situation where part of the activities fall within this exemption and part don't, and that brings with it the headache of having to calculate the elements of the trade that are subject to tax and the elements that are exempt. And the final point to note here is the size. You've got to be careful that the ancillary purpose trading does not become disproportionate to the primary purpose, which means therefore this exemption could be lost. So again, with auxiliary purpose trading, not quite as clear cut as primary purpose trading, and do need to take care. So small scale trading limit can be very useful if the trading activities do not fall within the previous primary or ancillary trading exemption. This applies if the turnover, not the profit, the turnover does not exceed a set amount. And the current annual limit, which is applied since April 19, is the greater of 8,000 or 25% of total income capped at 80,000. So if a charity has total income of 32,000 or less, the cap will be 8,000. Then you would look at 25% of total income up to income of 320,000, where it's capped at 80,000. And this is an annual limit, and you need to look at all the trading activities that do not fall within the exemptions and combine them to look at the income. Total income is all income received by the charity, except it excludes gains. So if a charity, for example, has sold a property and had a capital gain, that would not be taken into account in calculating this limit. Now, whilst it is an annual limit and it is an all or nothing exemption, so you don't get the first 80,000 or the first 8,000. If you breach the limit, the whole of the trading income or profit becomes subject to tax. But there is a slight get out if there was a reasonable expectation that the limit would not be exceeded. So, for example, it may have been expected that a grant was going to be received or a large donation, which didn't end up coming in, which means when you calculate the annual limit, the limit is breached. HMRC do and can expect to be shown evidence of that, so board minutes, budgets, anything that the charity can support the fact that if you're relying on this exemption and you breached it, it was totally unexpected, and you should still be able to claim the exemption, but its evidence will be important. And again, as for all the other exemptions, the profits do have to be used solely for the purpose of the charity. So you can see, I think, from that it may be clear cut, there may be no problems having a trading activity within a charity, but there is some risks. There are some tax risks, particularly if you're looking at ancillary trading, beneficiaries carrying out the trade, or you are seeking to rely on the small scale trading exemption. So what is the benefit then of operating the trading activities through a subsidiary? Well, on the face of it, a subsidiary is subject to normal corporation tax rules. There's absolutely no exemptions from tax as there are for the charity, and you need to prepare and submit a corporation tax return. So on the face of it, what is the benefit? Well, a benefit all relates to donating the profits back to the parent charity. A subsidiary can donate its profits to the parent charity and receive tax relief on that donation, potentially reducing the taxable profits to zero. And the charity is not subject to tax on that donation. So effectively, if set up well, you can move tax trading activities which may be subject to tax in the charity to a subsidiary, and then donate the profits to the parent charity, reducing any tax in the subsidiary to zero, whilst also the charity is not subject to tax on that donation. And the important extension, which is the benefit here for companies that are owned 100% by a charity or charities, is that unlike for normal corporates who can receive tax relief for donations, those donations for a normal corporate need to be made in the year in which you wish to claim the tax benefit. But if a subsidiary is owned by a charity or charities 100%, then there's an extension. And as long as the donation is made within 9 months of the year end, for tax reasons, for tax purposes, that donation can reduce the taxable profits of the prior year accounts. So it gives the charity and the subsidiary much more time to calculate the taxable profits and the level of donation that will be required to reduce the taxable profits to nil. So that is a benefit. And the other, obviously, other benefit is it avoids the practical need to consider the charitable exemptions that I've talked about, what may or may not apply, and therefore it does or can make life easier. But there are a number of things that you need to watch out for. Can the subsidiary donate 100% of its profits to reduce the taxable profits down to zero? Well, the donation is actually regarded as a distribution, and the company, the subsidiary, will not be able to make a distribution greater than its distributable profits, which sometimes can arise. And also, how is the subsidiary going to be funded? Is it actually able to donate and pay up the cash? Because it will have to pay the donation physically, transfer the cash. Can it actually afford to do that and still have enough money to run as a trading business? We would advise that different bank accounts are used for the subsidiary and the charity, and that it can be clearly shown that the donation has been made. There may be a difference between the accounting profits and the tax profits. So there may be tax disallowances such as depreciation, which means that the taxable profits exceed the accounting profits, and it's not possible to make sufficient donation. From an accounting point of view, there is a difference whether the donation is made under gift aid or under a deed of covenant, and that just relates to the year, the accounting year in which you account for that donation. From an accounts perspective, it does not impact the tax. And very, very careful, if the subsidiary is not 100% owned by one or more charities, the 9-month extension that I talked about on the previous slide does not apply. And for tax relief in the year, the donation must be made in the year. And this may not arise very often, but we have had situations where a subsidiary will be a joint venture between a charity and a non-charitable body, and that does need to be borne in mind, the impact of the timing of the donation. So what else should you think about if you're thinking about using a charitable charity and a subsidiary? Well, as I mentioned, how are the activities of the trading subsidiary going to be funded? Any investment or loan made by the charity down to the subsidiary must fall and meet the normal charitable rules. So it must be for the benefit of the charity. Any loan would need a fair return, and actually for that return to be paid. So there's a careful thinking there about how the charity is going to fund the subsidiary, or how the subsidiary is going to manage to fund itself. If it funds itself out of profits, then again, it might not be possible to make a sufficient donation to reduce its taxable profits to zero, and it might have to just be accepted that a bit of corporation tax is going to be paid. Very importantly, will there be any shared resources, for example, of property or staff? And as mentioned by Andrew in his presentation earlier, that's also very important from a VAT perspective. But from a direct tax perspective, it's also important. If the assets are owned by the charity, if the staff are within the charity, then these should be recharged to the subsidiary. Should they be recharged at cost, or should there be a markup included? And if there is a markup, what does that mean for the tax position of the charity? So careful planning is required on how the subsidiary will run and be operated and be funded. Record keeping is important. Make sure that the income and expenses of the charity and subsidiary can be accurately recorded. There will be additional responsibilities for the trustees, and also you need to be careful of whether there's any conflicts of interest between the running of the subsidiary and the trading activities and the trustees in the charity, particularly if the trustees are to be also directors of the subsidiary. And obviously you put yourself into a group situation, so the accounting arrangements and requirements will be slightly more complicated, but again, it's a fairly common arrangement and care just needs to be taken. So in summary, the trading activities may be best placed in a charity or in a trading subsidiary, or perhaps a mix. But it's very important that the activities that are or may be undertaken are identified, and therefore you can understand where they're best to be placed from a tax perspective. There may also be wider aspects in tax to consider, such as risks. The setting up of a subsidiary may be the answer, but there are benefits and there are drawbacks, and careful consideration should be undertaken before setting one up if that is being considered. And once it's set up, regular review of the activities. We would strongly advise that you take advice from both a corporate and a VAT perspective, and it's planned carefully, and as I say, regularly reviewed in case new income streams come online or there are changes to the activities that are being undertaken. So again, that was just a very quick review. Are there any questions?
Yeah, thanks very much for the presentation. We do have quite a few questions. We'll get to as many as we can. I think we have a good amount of time, so it should be fine to cover them all. First one is around closing a trading subsidiary. So what are the main issues to look out for if considering closing a trading subsidiary?
Okay, so when you're closing a subsidiary, whether that's owned by a charity or owned by a non-charitable corporate, you do need to consider what's in that charity. So, sorry, what's in that subsidiary. So what are there any assets or cash that need to be distributed? Are there any liabilities? And therefore look at the normal options. So can you just strike off the subsidiary, or does it need a liquidation, and what may that mean? So it's the same as really striking off any subsidiary of a company if it's no longer required. You just need to look at what the best, easiest option is. A formal liquidation would provide more protection to the directors, but it may not be necessary, and you don't want to incur unnecessary costs if you don't need to.
Yeah, that's it. That's answered nicely. Question from Emma here, which is, do you have any guidance around creating an intercompany arrangement or contract? So, for example, where the parent may offer discount or services on behalf of the subsidiary. Presumably, there are tax complications of these types of intercompany relations.
Sorry, wouldn't you mind just repeating that again so I understand the question? Sorry.
Yeah, sure. So do you have any guidance around creating intercompany arrangements or contract? And then just a few examples of that. So, for example, where the parent may offer discounts or services on behalf of the subsidiary company, the person asking the question presumes there are tax complications of these kind of relations. Yeah,
well, you need to make sure from a tax and from a governance perspective that any agreements between the charity and the subsidiary meet the charitable rules, which is why I mentioned about recharging for costs internally. So you do need to make sure that they all meet those rules, which would mean that they're generally mean that they're market rate and that they are documented correctly. So I hope that answers the question. I'm not quite sure about the offering of discounted services, but I'd be absolutely happy to have a chat with Emma offline to if she wants to give me a bit more information.
Yeah, so please do follow up, Emma, afterwards if there's any follow-up to that, but hopefully address the question. There's a question here from Rajan, which is, so the details are kindly on screen here as well to follow up with. Question here from Rajan, which is there a limit the Charity Commission in terms of, with the Charity Commission apply in terms of non-primary purpose, non-primary trading? I imagine that means non-primary purpose trading, which would undermine the charitable status of the organisation. So is there a limit to that kind of trading, I think?
Yeah, I'm not aware of that. I think it does depend on the activities that the charity is taking out as a whole. I mean, you wouldn't want the non-primary purpose trading to be disproportionate to the objectives of the charity. I'm not aware whether there is a specific limit. I think it would apply on a sort of case-by-case basis. And I think if you're getting to the level where you're worried that your non-primary purpose trading could be a problem from a charity governing rules perspective, then that is really when you really should be thinking about using a subsidiary.
Yeah, absolutely. A quick question here from Nicholas, which is, please could you explain a bit more how recharging at cost at a markup will work from a tax perspective?
Okay, so yes, just say that using the example of employees. So if the employees are employees of the charity and that employee is undertaking work for the subsidiary, then on an arm's length basis, if that subsidiary was not connected to the charity, you would make a charge for that service. So you could recharge the employee cost at cost, but you need to consider whether that is meeting the charity rules and whether from a charitable perspective, from the charity's perspective, they should be including a markup. So the charity should be getting more than just the cost, recovering the cost of that employee. And if so, what that markup should be. So you may wish to apply, let's just say, a markup of 5%. So instead of £10,000, you're paying 10,000 plus 5%. And then the charity is not only recovering its costs, but it's also making a slight profit. So you need to understand what's being done by who and what is the fair value for that service. And then if there is a profit in the charity, you then need to look at what that profit is on that recharge and whether it falls with any of the charitable exemptions.
Yeah, that's really helpful. A question from Simon. I hope I get this right in terms of it's so owning a charity runs gift aid scheme on admission. So I imagine if a charity runs a gift aid scheme on admissions, can this be run via a trading subsidiary?
Well, only a charity can claim the gift aid. So no, I would have thought. Yeah,
I think that's right. And then one more question before we go to ones that have been asked previously from Shrina, which is, do we need to show gift aid income separately within the corporation tax return? So slightly different question, but yeah.
The corporation tax return of the charity?
It's a good point. I imagine that's the case, but Shrina, do you want to clarify? Yes.
Yes. Well, so if you have to prepare a corporation tax return for the charity, then there is a supplementary page where you set out all the income and expenditures under the various categories. So often the charity itself will not actually have to prepare a corporation tax return.
Right, yeah, very few do need to. Thanks. Yeah, thanks for the other question as well, Shrina. We've got one or two that were asked previously, which we'll touch upon now, and I think some of them relate to VAT. So Andrew may come in for those, I think. Just let me find the question. And it's, So it's, we provide interpreting services through our trading subsidiary, and we've recently been asked to assist on a court case in Bermuda. Are there any VAT implications on this? The interpreter will be based here, I presume that means the UK, and provide it through a video link. It's an interesting question.
Yeah, sorry, it's slightly outside of what I was expecting on charities, but so what you're talking about here is the specialist place of supply rules. And generally, there's a general rule for services, which is the place of supply of services is deemed to be provided where the recipient belongs. So if you're providing translation services to someone who is not based in the UK, then it will fall outside the scope of UK VAT. If you're providing it to a business, let's say Bermuda, we could take Bermuda as an example if you like, but let's make it easier because France, I know things. If you supply services to a business in France, then they deal with any VAT under the reverse charge mechanism. If it's not to a business, you might have a VAT registration issue in that particular country, because you could be deemed to be making a supply that's liable to VAT, and as the supplier, you have to register. Bermuda is, I don't know if they've got a VAT regime. It's not one of the suppliers of services which, if you like, are deemed to be supplied where performed, translation services. So
I've quickly checked, and there are no VAT services in Bermuda. Just to say.
Okay. in which case, yeah, it might be that you don't have to charge VAT. However, you'd still get, that would still count as, that go towards your sort of taxable income. It gives you the right to recover on costs associated in making that supply. I think the only thing you'd have to be careful of is whether that, if you're providing it to a person and they were officially resident, their country of residence was the UK, it could still be liable to UK VAT.
So that answers your question, Denise. And keeping speaks on the toes with questions about Bermuda, and it's quite a tricky one. I think we've got time for a few more questions, perhaps one or two final ones. If there's anything you'd like to ask on, be it either around VAT and partial exemption and the issues there, or trading subsidiaries and the bits and pieces that Lucy touched on, then please do ask away. I think we have time for probably one more question. A moment for that. And if not, which I think I'll give you one more minute just to give you a quick opportunity to ask any questions.
If anybody thinks of one afterwards, my details are there, and I've also put Janice's details, who heads up our charities and not-for-profit sector generally. So if there's a non-tax question, then please feel free to reach out to Janice as well.
Sorry,
there is one final question here from Emma, so I wasn't left hanging too long, which is good. So it's just to check, if we sell advertising to charities for posting jobs on our charity website, the zero rate doesn't apply. Is it standard rated then?
So advertising, the definition of advertising for that purposes is if you buy someone else's time or space. So that would be advertising. So if you advertise your own services on your own website, that isn't advertising. But I think if you're selling advertising space on your website to someone else, and they are a charity, then provided they issue you with the correct certificate, then that would be a zero rated supply because it comes within the scope of advertising. It's not, there were some issues on sort of click view, when you click through, whether that's advertising or not. But I think this one, if you're selling something, it's just like, I guess, you are selling that to someone else to use your website, so they're using your time or space. My initial feeling is that the zero rate would apply if it's sold to another charity that issues you the certificate.
Great, thanks, Andrew. That's really helpful, and that's the final question of the presentation. The only thing left to do is to thank all the speakers we've had, both from Menzies and from Suffrage Champions as well. It's been really good series of speakers and some great questions and interactions as well. And their contact details are included on the slides that you'll be sent alongside the recording. So please do get in contact with any follow-up questions you might want there. So yeah, we'd like to thank our speakers. Harder to do remotely, but I'm sure we can do it either via the chat box or the round of applause button in Zoom. The only thing left to do is to remind you of upcoming events that CFG have. And tomorrow, in fact, we have one on gift aid. Quite a few gift aid questions came up in the session. So just a reminder, that's been shared in the chat by my colleague Sarah as well. And later on in January and February, March, we've got the Risk Conference on the 27th of January, which will be an excellent event. The technical update, which covers all things related to charities, be it tax, accountancy rules, bits on risk, legal changes, etc., which is coming up on the 24th of February. And then the IT and Digital Conference will be on the 23rd of March. If you're interested in any of those, please do get in touch. I'm sure there'll be follow-up sent in the follow-up to the presentations. So thanks very much for joining in, and I look forward to seeing you at the next CFG event. Thanks very much to all who've attended.